We hear this comment all the time. Brian, I don't want to turn on my RRSP or my CPP up in Canada because I don't want to have to start filing Canadian tax returns again. Today, we're going to talk about typically who needs to and who doesn't need to file Canadian taxes. Hello, my name is Brian Haggard. I'm a certified financial planner, chartered financial analyst, and I'm the founder of Retirement and Financial. We help simplify your cross-border retirement plan. And one of the biggest things that we help our clients with is tax planning. We help them understand what's the best strategy for withdrawing your money up in Canada. Do you take your RSPs and move it to RIFs? Do you take your liras and move it to LIFs? Or you just withdraw it all at once? How does CPP and OAS, how does that impact your US taxes? We put this all together and put together a tax strategy for our clients. However, one thing we don't do is we don't file taxes for our clients. We are not tax preparers. So today I'm going to give you a little bit about some information about typically who we see filing US and Canadian taxes in situations that may result in filing Canadian taxes. But I will also use a caveat. I'd really suggest speaking with your cross-border financial advisor or tax preparer before implementing any of these strategies. So let's start and talk about who typically do we see needs to file a Canadian tax return here as a US resident. There's a few things that come up that typically we see with our clients. One of the biggest sources of income that some of our clients have that results in them filing a Canadian tax return is if they have rental income from a Canadian property. We have a lot of clients that moved down to the US. Maybe they didn't sell their home up in Canada. Now they're renting it out. If that is the case, they typically are going to still need to file Canadian taxes. If you sell a home up in Canada as a US resident, typically you're going to need to file Canadian taxes. Another thing that comes up quite often is if you are working up in Canada and you are receiving stock options from Canada, either RSUs or potentially non-qualified stock options that are now vesting here in the United States, a lot of times we see that results in our clients having to file Canadian taxes because that was actually money that was earned up in Canada. And a lot of times, the longer they're here in the US, those stock options will go down and they'll eventually not have to file Canadian taxes anymore. But a lot of our clients, when they first move to the US, if they have stock options up in Canada, they typically will need to continue to file Canadian tax returns. And then last is if they're still working up in Canada. Maybe they're living in the US but commuting to Canada full time. We even have some clients that are primarily here in the US, but might spend 10, 15, 20 days a year up in Canada continuing to work for their company. Those clients, a lot of times, are still having to file a Canadian tax return. So, those are some of the big reasons that we do see people, filing Canadian tax returns. There could be some other reasons as well. You may have farmland up in Canada, things like that that may result in continuing to file Canadian taxes as a US resident. Now, there are some reasons that you typically don't need to file a US or Canadian tax return. If you are withdrawing money from your RRSP or LIRA, or if you've converted that RSP to a RIF, that LIRA to a LIF, and you're taking withdrawals, you typically don't need to file a Canadian tax return. Now, we're going to talk in a minute about why you may want to file a Canadian tax return, but you typically don't need to. Canada's going to withhold money from a RIF or a LIF withdrawal that's typically 15%. And Canada says, hey, we're fine. You don't need to now file another Canadian tax return. We've already got our taxes from it. So that doesn't typically result in a Canadian tax return. If you're just receiving a monthly pension from either like a municipality or a company up in Canada, that usually will not result in filing a Canadian tax return. You'll have to report that on your US taxes. Canada will withhold some money for taxes, but you're not typically going to need to file additional taxes up in Canada. If you are collecting your CPP, your Canada Pension Plan, or if you have OAS income here in the States, you don't need to file Canadian taxes. Actually, it's great because Canada doesn't withhold anything. You will have to report that as US income, but Canada doesn't withhold anything. You're not going to have to file Canadian taxes on it. One of the other questions that we get is, hey, Brian, if I sell any investments up in Canada, stock investments up in Canada, if I earn interest up in Canada on a bank account or GICs, do I have to file Canadian taxes? And the truth is that you typically don't. Again, that will all be counted as your US income, but you won't usually have to file Canadian taxes as a result of interest or capital gains if you're accruing up in Canada. Now, I mentioned before that you don't need to file taxes up in Canada. However, it may be beneficial for you to do it. If you have money from an RSP or a LIRA, or if you have pension income from Canada, there's a really good chance that Canada is going to be withholding taxes on those withdrawals. For example, if you take money directly from an RSP, they're going to withhold 25%. If it's from a RIF, it's going to be 15%. Typically on a pension, it's going to be 15% as well. So for a lot of people, they say, you know what? Canada is going to withhold 15, 25%. That's fine by me. I'm not going to file any Canadian taxes as a result of that. However, we do have a few clients that do file Canadian taxes, and it's called Section 217. And what that does is, and the reason they do that is they're maybe having 15% withheld from their RIF, but they might be receiving very little from that RIF. Maybe it's only four, five, six, $10,000. And yes, the 15% that they're having withheld in Canada is much higher than what their actual Canadian tax liability would be. And therefore, they file Canadian taxes so that they can get a refund from the amount that Canada is actually withholding. The other benefit of filing these Canadian taxes is instead of having the standard 15% withheld from RIFs or pensions, they can actually get their tax withholding lower. I have one client right now that instead of having 15% withheld from her RIF, she only has 5% withheld from her RIF because her Canadian taxes or income is relatively low. She filed this 217, Section 217 tax return and was able to now get a lower tax withholding as a result of it. So for some people, it is beneficial to file this 217. Now, who it will this maybe benefit? And you have to have two things typically in order for it to make sense for you to file Canadian tax returns. First, you need to have low Canadian income, right? If your Canadian income is really high, it doesn't really make sense to file a Canadian tax return because in all likelihood, the withholding or the taxes in Canada may be higher than the 15% withholding that you're having here in that they're already withholding for you. Canadian taxes tend to be a little bit higher, so it doesn't take a lot of income to exceed the 15% taxes that they're already going to be withholding for you anyway. So if you need to have really low, typically pretty low Canadian taxes income in order for this to be beneficial. Also, you need to have low US tax rates. When you're receiving money from Canada, Canada is going to withhold 15% typically if it's from a RIF or a pension, for example. But your income or that Canadian income still needs to be included on your US taxes. And the 15% that's being withheld will then count as a foreign tax credit and offset that income here in the States. But if your income in the States is all pretty high, if you're in the 24 or 32% tax bracket already, well, sure, you might file a Canadian tax return and you may get a little bit back from Canada if your Canadian income's really low, but you're still going to have to pay US taxes on that money. And just because Canada may withhold less on those withdrawals, or you might get a refund from Canada, you might end up owing additional money on your US tax return for it. So you might end up filing this Canadian tax return and not getting anything out of it, right? So this may be beneficial for you if you have low US or Canadian income, low US income, and you're trying to get that withholding a little bit lower on the Canadian side, and it's not going to impact your US side too much. Those typically are the situations that we find it beneficial. But at the end of the day, you also need to ask yourself, do I really want to? How much is it even going to cost me to file a Canadian tax return? A lot of people, at the end of the day, they say, I would rather just not deal with having to file these Canadian taxes. I'll just take the 15% that whatever the withholding is, even though it may cost me a little bit on my overall tax situation. If you're interested in exploring this or other questions, cross-border financial planning questions that you may have, please reach out to us. You can go to our website, retiremitten.com, and schedule a complimentary consultation with a cross-border expert. Thanks, and we look forward to speaking with you soon.